Good morning, ladies and gentlemen. What is happening? So, we've got ourselves our first, in principle, trading day where everybody is back to the drawing board. But are we actually seeing the interest across the board? What you've got to be aware of, guys, is volume is still light. Institutional fund managers are still away from the desks. You are still getting in line with this algorithmic trading. Why would they bring people back to work for 2 days to only leave the charts again going into Friday? You've got to remember, guys, today is Wednesday. Tomorrow being Thursday, then Friday, then it stops. So they're going to keep those algorithms working. Don't get it twisted. All marketplaces will be open, but will we get the commitment that we want? Now, this video is going to get you set up and aligned with what you need to be doing when it comes to trading Forex, having a look at the bonds, the yields, and really breaking it down. So let's roll with it. Okay. Kind of nice, isn't it? Nice and tidy. Got everything that we need in front of us. This is what I would be looking at when you want to start trading Forex, when you want to start getting into the indices, start using the legacy assets. Now, do not be intimidated by this. You have access to all of these assets. All you need to do is go on to MT4 and you just go to this tab right here at the top where it opens up all of the markets. Right click and go to show all, and it will present every single asset that you can trade on MT4. Now remember, MT4 is all about contracts for difference, okay? You're trading CFDs. Now what we're going to be doing is we're going to be looking into the futures markets. Now this is where your trading is going to change, ladies and gentlemen. And this is where you're going to have to make a decision. The decision is, do you trade when London is open or when New York and London are open? The best time to trade. You head over to Investopedia or anywhere you go. They'll give you a bit of a breakdown on when the best times are to trade. Okay? The US London markets overlap is what we like to call the crossover. Heaviest volume of trading and is best for trading opportunities. You need to make a commitment and say to yourself, am I going to be going into the new year looking for marginal opportunities, or am I looking for the best trading opportunities? Okay? So, going down. New York, 8 a.m. to 5 p.m., the second largest Forex platform in the world, watched heavily by foreign investors because the US dollar is involved in 90% of all trades. Okay? Key aspect is the New York session. Tokyo's first Asian trading center to open takes in the largest bulk of Asian trading just ahead of Hong Kong and Singapore. The currency pairs that typically have a fair amount of action are dollar yen, GBP USD, and GBPY, GBP JPY, dollar yen, okay? And then also the other assets that I spoke to you about, Aussie yen, CAD JPY, okay? Sydney is where the trading day officially begins. While it is the smallest of the mega markets, it sees a lot of initial action. While it is when the markets reopen on Sunday afternoon because individual traders and financial institutions are trying to regroup after a long pause since Friday afternoon. London dominates the currency markets world. London is at its main component. London is central trading capital of the world, accounts for roughly 43% of global trading. Okay? Has big impact on currency fluctuations because Britain's central bank, the Bank of England, which sets interest rates and controls monetary policy of the GBP, has its headquarters in London. Forex trends often originate in London as well, which is a great thing for technical traders to keep in mind. Technical trading involves analysis, blah, 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 blah. So what does that tell us? Well, what are the best hours? Okay? So here we go. Not all hours are equally good for trading. The best time to trade is when the market is most active. When more than one of the four markets are open simultaneously, there will be a heightened trading atmosphere, which means there'll be more significant fluctuation in currency pairs. Okay? Here is your spot. The key shows you. The volume is here. So come 12 p.m., just after lunch, we'll stroke 1 o'clock in the afternoon, going all the way into the New York session, 5 p.m. This is your window to trade, okay? That is your window. The US London, the Sydney Tokyo, this time period is not as volatile as the US London, offers a chance to trade. Period of a higher pip fluctuation. So the ideal currency pair is Euro JPY, okay? London Tokyo. This overlap, which is what I like to call the bread and butter trade, okay? Most US-based traders won't be awake at this time, and the 1 hour overlap gives little opportunity to watch large pip changes occur. Now, although it doesn't really see much, that is true, but that's why I call it the bread and butter. It's a quick scalp in and out, okay? Now, going over to the charts themselves, you've got to say to yourself, what am I going to look for? Do I want to trade Sydney? Do I have any choice but to trade Sydney or the UK session or the US session? Now, you've got to say to yourself the following. What is happening in each of the sessions, which is why it's critical to go back and look at what is happening in each session. What has Asia done? Has Asia marked up price, come back down halfway, consolidated, gone into the close? Has UK decided to do a stop run low and made a move to the upside to come into line with the US session for the US session to do the same thing to try and bring it back down again? You are looking for the sequence of behavior between Asia and Sydney. Now we're going to go and do that ourselves. Check this out. We're going to check out what's been going on across the board. All right? Now, because if you have no choice but to trade the UK session, all right, this is the tech German market, all right, which would be the equivalent of the NASDAQ in principle and the S&P, but for the German market. Now, why is the German market important? Because Germany is the largest economy in the Eurozone. So if these guys start selling off, then there's a good chance that you're going to see the value of the euro going down and all assets against the stocks that are priced in the euro, so the euro index, will also start to work their way down too. Now, looking at this, the tech German market itself, you can see bright as day that we have got a structural high up here where it looks like we've got an M formation, we've got a drop. Now it would be apparent that we could be seeing a retrace into this zone, okay? So if I get this back, oh God, this tediousness of MT4, we would assume that this is the level 1. So we're anticipating a little bit of a retrace to happen, but remember, volume is light across the board. And this market is also closed because look at where we are this time of day. It's not, there's no volume across the board, okay? But structurally, we are expecting them to try and work their way back down again. Look left and you can see that you have got this one interesting point in the chart, which carries a very big vector candle. This is naturally where you would assume that liquidity came in. So it's the only next point in the chart that they can make their way towards on the premise that they can hold inside of this region right here. And of course, this zone down here, we would assume that if the German market itself starts to drop down lower, then we would anticipate euro to do exactly the same thing, because that means that if they're selling up stock, they're selling against the euro. Investors who are institutional traders that convert dollars into euro to buy these stocks in the German market will be exchanging those stocks back into dollar. So they want to get rid of those assets and change it back into dollar. Okay? Cool. Now, that's the German market. So then we can go over to the euro itself and we can have a conversation about what is actually happening. Now, look, you can see bright as day. On the euro market, Euro USD itself is consolidating sideways. We've got both the Asian sessions from yesterday, from the 27th, and we've got the Asian session from today. Okay? It looks as though that each session marks price to the upside. Okay? And so far, what I'm understanding is by them marking price up, UK follows suit, and then they take a nosedive either in the UK session for them to set it up in the US session to try and do the same thing. What we're witnessing here is the UK session is sort of doing the same thing right now. Again, look, markup to the upside, drop. Another markup, drop. Markup to the upside, drop. Another markup, drop. Whole and half number principle. What is going on inside of this area? Now, let me tell you something. They may even keep euro inside this zone until the 1st of January. You see, what you've got to understand, ladies and gentlemen, that we are getting closer and closer to the news announcements. Check this out. Unemployment claims come out tomorrow at 1:30. There's going to be a lot of volatility. Although it's not that much of a great reading, it's still a reading nonetheless. Unemployment claims comes out lower. That just installs the idea of a very strong labor market. Now, what you've got to consider is the following, guys. Euro could actually stay going sideways. Euro could move up towards the 100, the 1065 mark right here and try and take out some stopping-like behavior. You're probably not going to get no movement until everybody comes back to the marketplace. Okay? Upon the success of them trying to move up, we look onto the higher time frames like the 1 hour, and you can see bright as day that it is just a creep. They're creeping price upwards. Okay? Yeah, we've got this vector candle happening up here, and the 107 mark does look like there could be a promise for them to come up towards it. So if you were to try and exploit that and take a swing trade in anticipation that they're going to come up and hit this point, you must be very cautious about what could happen down here. Because you can see that these two candlesticks right here, the stopping volume candle 1, stopping volume candle 2, right here, could be giving us a clue that if they do try and go lower, then we would expect volatility inside of this range. All right? That's what we would expect. Now, what you've got to understand is euro is currently trading away from its peak formation. Now, something about peak formations is this. This whole area has consolidated sideways for such a long time that it's now formulated a peak. And that peak begins here. So you've got 1, you've got 2, and you have got 3. Okay? That's where the peak formation resides. Now, of course, you can see I've just added a couple of indicators, okay? And you can see what we've got right in front of us. We've got the ADR. And Euro's ADR is on average 84 pips, okay? Have they achieved an ADR of 84 pips? Well, let me just quickly add the daily open line right here. Drag that. Make that a little bit thicker so we can see. Happy days. There's our daily open. Cool. Have they moved away from their ADR? 84 pips. So we take that. 84 pips would take us all the way up towards this high right here. And that's our ADR high right there. Now, what you've got to understand, ladies and gentlemen, is the following. When you do not have any movement. So, ADR has not been achieved. Now, this is where the criteria of discipline comes into play. If you have gone to an asset and you have not seen any movement in terms of the ADR, you do nothing. Euro's not doing anything for me. Why am I going to take a trade? Where do I trade off this principle? I need to see a bit of a movement. I want to see a reason to believe that they're going to try and mark up. Why am I going to be in a marginal trade? You want to play this game of finding the best trading opportunities, then your trading selection or your frequency of trading will be drastically reduced. What do you want to do? Do you want to show that you can trade lots, or do you want to show that you can take a trade and get paid? Less is more. We understand that, and that's the case with trading. Every day you'll be presented with an opportunity. But every day is about you trying to find whether that opportunity is going to pay you or not. And the only way you do that is if you improve the odds of trading at the right time. Whether it's London or the US session, both combined. You use this time to develop the narrative and the basis of what to expect. What could they be doing? Look at what time of year we are in right now, guys. It's not a good time to trade. And that is evident with the way that they are moving. What's going on across the board? Here we have the treasuries. And these are the 5-year treasuries. If we go back to TradingView and we look at the treasuries, this is the 10-year yield, okay? And the yield is pointing down, all right? Let's go to the hourly. The yield is pointing downwards. Well, it's moving up quite drastically. And Goldman Sachs did say that by the end of 2023, we'll probably be around the 4% mark, okay? And we're already heading towards the 4% mark. That's where the yields are. So that tells me that the yields are trading negative for the day, but it seems like there's a little bit of a hold in the zone. Principally, I've got this area right here, which tells me that there's a gap in the chart. I would anticipate they'd want to try and come and fill that gap. Going into the 10-year bonds, okay? This is the bonds market. Bonds market is trading upwards. So we've got movement away from the daily open, but markets are quiet across the board. We go back to this asset right here, and this is, I'll show you. Let me just bring it up for you. You scroll down, and this chart right here is the UST notes on the 5-year, okay? It doesn't have the 2-year, but the 10-year notes themselves, 138. All right, so this is the 10-year. Where's the 10-year? Where's my 10-year, 10-year, 10-year? I actually haven't got the 10-year on the charts. Get the chart window. Right-click, template, black. This is the 10-year. Now, the 10-year notes, all right, you can see that they're moving up, 138. Now, of course, this is CFDs, and you've got different contracts, US 10-year. All right, if we look at this, symbol info. This is the United States 10-year government bonds, okay? And this is the notes, the 10-year notes, okay? Now, what's the difference between the two? So, what's the difference between the US 10-year bonds versus the US 10-year notes, okay? What's the difference between the US 10-year bonds, why 10-year yields? They're pretty much the same thing, ladies and gentlemen, okay? So it's what is a 10-year treasury note? 10-year note is a debt obligation issued by the US government with a maturity of 10 years, okay? Treasury note pays interest fixed at a rate once every 6 months and pays face value to the holder at maturity. US government partially funds itself by issuing 10-year treasury notes, okay? When you Google all that, understanding 10-year notes, the US government issues 3 different types of debt securities to fund its obligations. Treasury bills, T-notes, treasury bonds, bills, bonds, and notes are distinguished by their length of maturity. T-bills have the shortest maturities with durations only up to a year. The Treasury offers T-bills with maturities of 4, 8, 13, 26, 52 weeks. Treasury notes have maturities ranging from a year to 10 years, while bonds are Treasury securities with maturities longer than 10 years. Okay? Treasury notes and bonds pay interest at a fixed rate every 6 months to maturity and are then redeemed at par value, meaning the Treasury pays the principal it borrowed. Now, you always hear me talking about the bonds and the yields have inverted. And what does that mean? The time that people spend giving money to the government and wanting it back is drastically reduced because they're getting the money back sooner. They are earning the same money that they would have locked in on a 30-year treasury note in a 10-year note. That's where the yields have inverted. So how do we use this information? Well, what you've got to understand is pricing of the 10-year notes is going to vary across the board, okay? So this is the US 10-year treasuries. All right, this is important. And then you've got this right here, which is the US 10-year notes. All right, so it's a different type of debt. But what you've got to understand is if they are all moving up, that means people are putting their money into the government. Okay, they're buying up the government interest. If it's moving down, it means people are not buying the government debt. They are putting it into cash and they are trying to avoid that, which naturally would lead the yields to move up. Okay. Now, dollar dominance. Dollar dominance seems to be doing some very interesting behavior, trying to work its way up. Yes, we do have this vector candle principle down at these lows. Okay. Now, the problem that we've got is Dixie has formed a peak formation. What do we mean? Here's the peak. 1, 2, and now 3. Problem. The longer Dixie stays inside of this zone, ladies and gentlemen, the more inclined we are to believe that they're going to get ready to try and mark price up. Okay? This is the issue that we've got. Dollar has made its move away from this peak formation. It's now retraced back into that same zone and found a lot of support inside of here. Look at the volume. The principle would say that dollar dominance is getting ready to try and mark price up. Higher time frame analysis goes to the 4-hour time frame and suggests that this could be a point where Dixie actually makes its way towards. It's gone above the 50 EMA after struggling to get above it for some time. There could be now a change in sentiment. Big push on the blue vector candle down at the lows right here would suggest that that could be the case. Volume has surpassed across the board with this blue vector and gone into the last point where they moved price up. Is this suggesting that dollar dominance is going to start coming into play? The volatility index holding at these lows. They've recovered this vector candle principle. Although it's not fully open just yet, one would assume that we're getting ready to start marking up. We are trading in and around the 20 zones. We expect movement from here. Rolling back into assets such as Bitcoin. We'll look at Bitcoin. Bitcoin ain't doing much. Bitcoin's looking like it wants to try and make its way up towards the daily open. But volume is sparse across the board. Nothing's happening. You can take your VWAPs. VWAP is pretty close for the week. We've had a little bit of volatility, but not that much volatility. We've come back into vector candle principles. We've come back into the blue vector candle principle. And we've still got a little bit more of a vector down at this point. Is it possible to assume that before the new year, they actually keep price inside of this range? So what I am going to be suggesting that you do is you go over these assets. Okay? You go over these assets and you work out how to really work your expectations. Yeah? This is the UK government's. This is their bond market. This is the German market. This is the DE40. Okay, so the DE40 is what? Go down to the DE40. Where's the DE40? Where's my DE40? There you go. This is the Germany 40 index. So it's another index of assets. Okay? Looking at things across the board, one would naturally assume that Dixie's going to continue higher. All right? You've got oil climbing up, usually consistent with traders seeking commodities for safety. So as long as oil's moving up, then we have ourselves a little bit of a tricky situation. Which at the same token then leads me over to the idea of gold. Okay? We go over to gold. We get a new chart. We open up gold. Let me get gold metals. UED. Happy days. Roll that out. Template. Bang. Gold's looking like it wants to come back up and recover this area right here. Holding inside of this zone. We zoom out. You can see that they are peaking out. It's stalling inside of this zone. The longer that they support this area, once the markets open back up again, we would then assume that gold's going to look to try and move up again. Now's not the time to trade. You guys can see that as bright as day. It is moving slow across the board. Let's go back to Euro for a split second. Euro's pumping up right there. Here we go. Let's go to the 1 minute time frame. Where's Euro actually going? Now for my scalpers, it's happy days. Look how long it's taking this bad boy to move. Doesn't really do much. It's not moving at the speed that you want it to move at. And these fast moves here are because volume is light. Look, this is a light volume candle. Okay? Now, zooming out a second, you can see that Euro is coming away now, working a potential ADR move. So let's work up. Where are we at? It's making a 10 pip move to the upside. 10 pips. Okay? Now, from a scalper's perspective, it's great, you know? You can try and exploit this kind of thing. Here's an example. It's trying to exploit a scalp. Okay, only a small amount. Take advantage of a quick scalp on euro. A little bit of volatility right there. It's hopefully that we can get ourselves a little bit of a pip movement. Here we go. Nice little play there. Just get my pip counter. .8 minus 0.8 pips. They come back down. Big move up. Big orders coming in or light orders coming in, moving price. Smacks it back down again. Back up again. Can we get that? Can we get the continuation? Very slow. Look, this is how you test. You test with one light trade. Look at that. Look at that pause. That is horrible. Nothing. Why am I going to try and scalp this? Look, it's paused. What do I do there? Oh, nice big spike there. What if it's not the spike that you want? What if it goes against you? I hope this makes sense to you, ladies and gentlemen. Look at that. Back down. Horrible. Why am I going to play that? As much as it looks seductively amazing to try and take advantage of, there's no point. Markets are not where they need to be. All right? Likewise for Bitcoin. Okay? So, to break it all down for you guys, when it comes to actually getting yourself prepared, the first thing that you need to be establishing is the following. I'll get it all typed out for you. Here it is. Like a little key for you. You first come to the charts and you say to yourself, I'm committed to only trading the London US sessions, hypothetically. Okay? First thing you're going to do is you're going to look for the German indices, the UK bond market, and the US bonds markets, the Dixie and the VIX. Okay? The UK bond markets themselves, if you go to MT4, if you do have it, see, look at that, man. What a treacherous thing. You go to the UK bond markets and you will be looking for the ticker symbol UKGB. Okay? Which is normally known as the gilts for the UK market. If the bonds market themselves, because the bonds markets are closed, okay, in the UK. The bonds markets themselves are on this platform, that is. The bonds markets are showing, okay, that they are picking up the UK bond, all right, but they're only coming back up towards vector candle recovery, all right? We look at it across the board. We then say, okay, is that the same for the US? Yes, that's fine. We look at dollar dominance. Where's that? Where's dollar dominance? Yeah, dollar dominance. Dollar dominance looks like it's trying to climb and creep upwards. Okay? And then, of course, oil starting to climb up. Volatility index is holding at this point. Could they come back down lower? Could we get a little bit more movement? The German tech market itself consolidating inside of this area, showing a little bit of resistance, which could lead euro lower if the tech market starts to sell off in the stock market. Okay? And then you've also got gold. All right? So then we go back to this and say, okay, so what's the general narrative? Where are people's heads at? Once you've done that, you go over to the UK and the Asian session marketplaces. Go back towards that zone itself. You pull up the Asian session high, the Asian session low, and look at where you are. Zoom out. Have a look at what's happened in the previous session. Because when you look back, ladies and gentlemen, you can see bright as day that each session, rule of thumb is this. The wider the Asian session, okay, the more of a manipulative day you're going to see. Look at how wide Asian session was, over 73 pips. And look at the US session, nearly 52 pips. Isn't it ironic how the lengths of the Asian session and the US session are in line with the stops that traders put their positions at between 25 and 50 pips? So they've been doing stop runs. And it's the same with the UK session as well. Treacherous day. You want the sessions to be smaller and tighter. You want the Asian session to be within a 50 pip range. We look at this, 23 pips, it's below our average. 30 pips, it's below. or it's within the average, but it's a small session, suggesting to me that things aren't really volatile. The daily opens are close to each other, suggesting to me we've got no movement. Do you want to be trading these situations? Okay. Looking at the Asian session high, Asian session low from the previous session, then looking at this session, Asian session high, Asian session low. Are they shifting value lower? Is that because the markets are closed? Any spike up to the upside, they're already giving us that prospect right there with these wicks to the upside, so be careful. US session could bring a little bit of volatility. But be mindful. I'm saying to you, wait until the new year starts, guys. It's going to be hard. But this practice alone is going to get you geared up for the new year. Go back and study. Pull up one point in the chart when euro makes a high. Go over to the bonds market themselves and have a look at the difference between the two. So if I do that right now, check this out. Here we go. So look at this green vector candle right here, 13th of December on the euro. Price marks up, yeah? At the same time, the German bonds market do exactly the same thing. They mark up, okay? Then they start to sell off. They start to sell off aggressively, okay? Then you look at the euro itself, and then it starts to sell off, but not so aggressively. Listen to what I've got to say here. When you trade an indice which is made up of stocks that are purchased in euro, if you want to trade the volatility of that stock market, you do not trade euro. Euro is the end result. Okay? Look at how quick these bad boys drop. The sentiment between buyers and sellers is a little bit higher in a German market, or should I say in an indice, because an indice is the collective of traders getting rid of stock. In order to get rid of stock, once they sell the stock, they obtain the euros. Once they then have the euros, do they then convert it back to dollars, or do they then convert it back to Aussie? Do they then convert it back to Swiss? Do they then convert it back to yen? That's why when the euro market itself drops, and then you've got euro here not dropping as significantly, it's because they're trying to transact. Some of them might not be in an agreement with transacting. Mainly German market players or institutional German market fund managers are getting rid of their stock, transferring it back into dollar or cash. Whatever it is, that's probably why they may be holding euro. Could they be getting rid of euro stock and keeping it in cash? Because usually what you would like to see is you would like to see the euros dropping at the same time as this marketplace itself. Well, let's just look at this. Euro on the, let's go to the 30th of November. All right, so we go to 30th of November. What happened on the 30th of November? 30th of November at, let's say the start of the marketplace was there. Let's just assume that was the case right there. 30th November, and that was at 7 a.m. 30th of November, 7 a.m. Okay? So you can see both instances right here that the euro and the marketplace itself were actually in sync with each other. Okay? You zoom in, you can see that you've got big red vector candle right there. And you zoom in, big red vector candle right there. They shift out, so does euro. But this is a little bit more volatile. Let me tell you, you want to start trading these indices, you got to be very cautious because these indices are crazier than Bitcoin. Okay? I'm telling you. They trade well and they move well. And we're going to be diving into this bad boy. Look at that. Beautiful movement by the indices. Okay? Look at that. Climbing nicely. Yeah? There's clean plays with the indices. Euro ain't so clean at times. All right? Now, with these, you only pay a $50 spread. That's nothing. $50 spread, guys. Look at it. We go into the smaller time frames. Look. You can scalp that. It's only a $50 spread because no one really trades these markets. It's a small, not a small market, but everyone trades the bigger markets. That is why you see them with wider spreads on the NASDAQ. This is a 14,000 euro price scale. NASDAQ is around the 11,000 mark, but the spread is wider on the NASDAQ than it is on this. Why? Because more people trade the NASDAQ. They need to advertise this to make it look more lucrative. I hope that puts things into perspective, ladies and gentlemen. It's a bit of a long update for you, but it's more of a lesson. Okay? Use this structure right here to get yourself aligned with the marketplace. Remember, nothing is happening in the markets. It's not a great time to trade. But get yourself aligned and prepared with what to expect. We're going to be going over some more aspects later on today. Mad love and respect. Peace.